listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. With me is returning guest, one of your favorites, one of my favorites, Vince Lanci from Echo Bay Futures, also writes the Gold Fix. Vince, there's several things we want to talk about today, but starting off, let's talk about buy season. You call it buy season, where it looks like sell season is we're just about done with it. Now we're getting into the holidays, which you call buy season. Tell us about that and the importance.
Yeah, I mean it's a time of year between say Thanksgiving and the New Year, where banks and investment advisory firms put out their allocation recommendations. Now, we've all seen these before. We recommend you put 5% of your money in this, 10% of your money in that. And the reason it makes a difference is people will trust in these things. So, the whole 60-40 portfolio, 60% in stocks, 40% in bonds. Well, that's like, 20% of your money now goes into commodities, and 10% of that goes into gold, 10% of that goes into, half of that goes into oil. But it varies from bank to bank, from RA to RA. But these recommendations coming out have a tendency to bunch up interest. And when they come out, it's kind of like, opening a door to a new nightclub. A lot of people come in, at first, and it tends to distort the market over the next month, which is good and bad. It's good because we want the market to move, to react to investment flows, but we don't want the market to give us false promises of infinity. You know what I mean? That's what happens. But the reason I think that's really relevant, I'm glad you asked me about it, is because it dovetails right into how this all started, with the whole CPI lunacy.
Yeah, what do you mean by lunacy? Are you talking about the reaction to it, how obsessed people get with it?
No, the reaction. You're absolutely right. It's the reaction. Like, all right, here's what happened, right? CPI comes in a little bit lower than normal, right? A little bit lower than what's expected. So we're in a disinflationary trend. We're backing off of inflation. That doesn't, your goods aren't getting any cheaper, but they're getting more expensive at a lower rate. That's beautiful, right? Isn't that nice how they make us feel? There's the CPI comes in a little tiny bit weaker than expected, and everything ramps. Gold ramps, bonds ramp, and stocks ramp. And in the stock market, you actually had a ramp of not just your big tech, but a much broader based rally. And everyone out there that's a very statistically oriented person, which I am, was saying, well, this is an overreaction. Gold shouldn't move this much on CPI. It was a little tiny miss. And I'm like, no, it's buy season. It's buy season. And the reason I bring it back to buy season is because I think all these recommendations that banks had, whether it be for gold or stocks or selling oil, because that's what happened too, they all get bunched together and they get released when there's a clear runway. Like, think about what happened in the last week, right? CPI came out and it came in low, implying that the Fed would do nothing for the rest of the year. That's what that says. That puts a nail in the coffin. The Fed's not going to be active for the rest of the year. That's what that means. The other thing is, we were talking about the government shutdown last time. No government shutdown. No government shutdown. And the government shutdown is going to be punted out to mid-January. And while that's bearish for gold in the short term, the CPI just overwhelmed it. And I think all this pent-up demand for the nightclub that's opening up, I think the nightclub opened up, and that's why gold has been ripping since the Israeli-Hamas war. But this little boost this week was on the back of CPI and the the government shutdown being delayed. So I think we've moved from like the ante room or corridor of buy season into buy season, and forget the whole buy season concept. I mean, that's a phrase that I use, but really what it is it's 2024 asset reallocation IDs are coming out, and so people are putting their money into them right now.
Yeah, I just because I want to touch on that, but one quick follow up to the CPI and the market reaction. The weak dollar is certainly helping. If you look at since the end of October, dollar has fallen from almost 107 down below 104 today. Not a huge decline, but that's been more. I mean, during this little rebound, the stock market has outperformed gold. So it feels to me that this little rebound that we have in gold up to 1983, I think, on the continuous contract, it's damn close to those breakout levels. It's still holding there, but
right.
What's going to? So I guess I could do two questions here. What is going to get that? Because we're going into buy season, but gold doesn't have much more room to rise without it being a significant rise, because last buy season, remember, it was oversold. It was in the low 1600s. So it had room to rise without impacting the other markets. I know that people and everyone really are underinvested in gold right now, but it's 1983. I mean, we're sitting, 2 or 3% away from a weekly all-time high. So how can this break out if the stock market is outperforming and now it's rebounding, and so there's more funds are going back into the stock market? So I don't know if there's a question in there or just a bunch of jumbled thoughts.
No. I think what I'm hearing is you're talking about a situation where there seems to be conflicting forces. Just backtracking to the first thing you said about the dollar, right? The dollar has been strong for the last 2 months in general, and it did not affect gold, right? Real rates have been very positive for the last couple months, did not affect gold, right? Third thing, the Israeli-Hamas war started, that put another bit into gold. So which brings us to your second point, which is the market rallied early, right? I mean, you're talking about the sell season, buy season transition. Like you said, last year we were in the 1600s. We were oversold on the lows, lots of room to run. So now, if you want to be well balanced about it, you look at it and say, well, you know what? We're not off the lows. How much higher can we go without us breaking out ridiculously higher? Well, the bull in me says it's going to happen, Jordan. It's going to happen, But the realistic person in me says, yeah, you know what? Number one, we would have been trading 1850 had the war not started, right? That puts $125 in gold. That's war premium right there. So let's call it $100 in war premium. We're trading 1980. We should be trading 1880. So now you ask yourself, okay, so now we've got all this fresh buying that's coming in, that's seasonal buying on top of the war premium, and now the dollar is ticking down, right? Now the dollar is ticking down aggressively. That should be, and I'll give you the non-crazy example. Given the drop in the dollar that we had this week, gold didn't really rally that much. Silver took off, but gold was kind of a muted rally in comparison to if you're looking only at the dollar. So when you look at it that way, the dollar crapped out, right? For a couple days. Stocks ripped, gold ripped, stocks ripped more, gold languished, silver outperformed everything, and you're like, hey, what's going on with gold? And I think, if you look at the fact that going back to what you said before, we're not on the lows, $120, $130, $150 in war premium go into there. And so there's probably a lot of people hesitant to buy this so close to all-time highs, and there's probably stops above, like we've talked about before. But, I want to say I want to say, and I'm not qualified, but I want to say this is a healthy underperformance. There are no healthy underperformances, So I'm a little bit concerned, but I'm also very happy in the sense that I believe that gold has two things going for it right now. One is global unrest, call that the war, has put a bid under gold, right? And the second one is, although it's not inflation, it's kind of crazy, but if the Fed is, the whole CPI thing basically said the Fed's not going to tighten anymore. Well, it's like, well, that's because we don't have inflation. So gold should go down. No, it means gold should go up because the Fed's probably going to ease. Now, I'm not saying they're going to ease, but the market, like, for example, let's just take the negative side of this. The stock market's ahead of itself, right? I mean, come on, he's not going to ease tomorrow. It's crazy, So therefore, gold should be ahead of itself. Therefore, all these things are overbought. So I think a healthy skeptic says, I'm taking profits. And in fact, I am. I sold a third of my gold position today and 2/3 of my bond position. So I may be hoping for the best, but I'm thinking more like you right now. Just being a little bit careful. There's a lot of buying in the market. Why haven't we made new highs? That's a good way to look at it.
So then, I guess circling back to buy season. So, did the Israel and Hamas and that? I mean, did that usurp buy season, or did that just kick off buy season? And then at the same time, I mean, can buy season just go on and gold consolidates here between 1,800 and 2,000?
No, it's been really hard for me to put a weighted value on that. Meaning we're from the end of September, from September through Thanksgiving, give or take in the U.S. Some funds generally liquidate. So the bigger funds, the bigger macro funds that are long only, they start to get out as redemptions start to say, I want some money back. So redemptions come out first. They don't come out, but they start preparing for redemptions. And you start to see the market ratchet down, the open interest decreases, what have you, right? So now you have the accumulation of recommendations that are coming out, but you don't have any new money allocated yet, right? So you're holding on to those and you're saying allocations are coming out. We should have an increase in gold in our fund next year, but we don't have the money allocated to us yet. So here we go. We're holding off. And then the war starts and it's like, oh crap. And so people pile in early. And that's the problem. The problem is not only did price appreciate too quickly because of the war and not back off, but you'd be naive to think that some of that, quote, buy season money didn't get deployed early. It was just too important. It's like I need to put the money in gold now. I can't wait another month. And so they did that. And I think that could be one of the reasons that that even though we're strong right now, we could be toppy. Buy season could end early. How's that? Right? Buy season may have started early and ends early. That's the concept.
And also, not to take away from, you had the 10-year run up to 5%, and you had the curve was getting really close to, going above zero and giving that recession signal. So that also brought in a healthy amount of buying. And of course, this rebound in the stock market has occurred when, with the rally in bonds.
Yeah, it did. It did. When the bond market was getting slaughtered for 2-3 weeks, gold didn't do well, but the bond market did so poorly, gold should have done worse. It really, I mean.
Well, if you look at the end of it, gold was going up.
No, that's right.
The last little bit of the move, gold was going right up with
that's right.
with the long-term bond yields.
Right. No, that's right. That's right. The picture that I see in my head is looking at that, remembering what it looked like. It's like bonds were coming off at a faster rate than gold was, because I was actually short bonds and long gold at the same time. Right. So as the bond market was dropping or yields were climbing, gold was dropping too. And I'm like, okay, well, I'm saying that doesn't make sense. gold's discounting a recession. Why the heck are bonds getting so slaughtered? Why are yields rallying so much? To your point. And then it got overdone. And I think, I mean, it's easy to say that after the fact, right? But it got up to flat, as you're saying, right? And we were having a serious bear steepening. And that stopped. But before bonds turned, gold turned. That's right. Gold turned before bonds turned. So it's almost like gold's dropping, bonds dropping more, gold's dropping, bonds dropping. Okay. Bonds keep dropping, gold turns a corner, and then 3 days later, the war starts. Bonds keep dropping for a couple more days, and then bonds turn a corner. Really, I mean, that's what happened. So when you look at it in combination, bonds should have made gold drop even more. The rates, the rates are so high, the whole Bloomberg story, rates are really high and that's competing with gold investment. Well, gold kind of held its own. So you can make the argument that gold's overpriced in the short term. You could also make the argument that it should have been a lot lower before and now it's poised to rocket higher. I don't know which camp I'm in. I think it's really important to be technical right now. You have your levels, you trade them. Stories don't matter right now. And I'm a story guy, stories don't matter right now.
Yeah, and just back to gold against the stock market, the bottom in the stock market at the very end of October, the two have been negatively correlated over the last month.
Right, because of the war, right? I totally see that. Yeah.
Right.
But where does bonds matter? How does bonds fit on that? Bonds shouldn't be negatively correlated. You know what I mean? Like bonds shouldn't be stocks are dropping. Forget it. Just
well, yeah, because bonds are in this. When bonds were getting up to 5%, I don't want to say that's recessionary, but
right.
There's that's kind of an important level. And so, the curve was getting really close to going above, it was the bear steepening, like you said, it was getting really close to giving us a recession signal. So that, and that's negative for the stock market, and positive for gold at the same time. Plus you had the geopolitics. But now, because if you go back the last year or so, when you had these, like if you look closely and when you have clear moves up in long-term yields, like a strong uptrend, the stock market sells off when that happens. Once the 10, yeah. So they're kind of, that's how there's a bit of an inverse correlation in how gold is acting. And that's a problem. A lot of, gold bugs, and I put myself in that category because a lot of people, they're looking at the last 20 years and say, oh, well, well, actually scratch that thought for a second. We're having a different setup. And so the question with bonds is what is going to cause gold to break out? Is it going to be the 10-year making a move above 5%, in the first, quarter or half of next year? Is that going to cause it to break out, or is it going to be economic weakness in the 10-year?
Oh, okay. No, so I never thought of it that way. Okay,
that's how bonds fit in.
Okay, I'm with you. All right, so let me paint a little picture because you're describing something I noticed in gold, in the drivers behind gold, but I didn't think about it in bonds. But you're right. The drivers behind gold for the last year have been geopolitical turmoil, Israel, Hamas, and before that, the banking collapse. So SVB. So financial crisis made gold rally. I don't trust banks anymore. Boom. A military geopolitical crisis made gold rally, and inflation fears made gold rally. So all the normal flight to safety reasons made gold rally. And in those situations, you had gold rallying, right? Okay. And this is why the CPI is really so important. And I think we might be at the cutting edge here. We could be completely wrong, but we're at the cutting edge. And the cutting edge is CPI cemented the market's perception that inflation is really under control and the Fed will do nothing for at least 2 months. Having done that, at that moment that happens, that's bullish for gold, bullish for stocks, bullish for bonds. You with me on that so far?
Yes.
But none of those things are the reason gold rallied to begin with, right? We rallied because of a banking crisis. Well, there's no banking crisis anymore. Sell the gold. We rallied because of Israeli Hamas. Well, the war is still going on, but there's no oil risk. Oil's telling you not to worry about the war. Sell gold. So the what do you call it? The flight to safety reasons for gold being bought seem to have dissipated. And now everyone's buying, everyone, who knows if it's everyone, people are buying gold because of the Fed might ease. So I don't like that. I mean, I'm trading it, but I don't like that. And I would prefer, as cynical as it sounds, I would prefer gold to be bought because we're worried about inflation. Well, we're not worried about inflation, right? We're worried about the war. Well, apparently we're not worried about the war anymore. Oil's down $5, right? We're worried about the banking crisis. Well, that's been solved. So why are we long gold? And we're long gold because we think the Fed might ease. That doesn't seem healthy. So I mean, just deferring to the concept you're talking about. Now we bring it to bonds, right? Okay, so bonds are rallying. I know why bonds are rallying now. Bonds are rallying now because CPI is lower. The government's not going to shut down in mid-January, and for some reason, they think the Fed's going to ease. So bonds rally. Bonds become like a stock. Bonds rally, golds rally, stocks rally. I get that, but I can pretend I have the answer, but I don't. If you go back and look at the last three crises, the banking crisis, the three reasons to flight to safety, the banking crisis, that wasn't bullish bonds. Bonds didn't like that. The war. Well, as you noted, the bond market didn't turn from the war. It turned, it kept going down as gold was turning up. I think it might have to do with the credit rating downgrade too. So if the correlation between bonds and gold is broken right now, that's where I'm sitting right now, right? Why are bonds down? They might downgrade us. Why are bonds down? The government might shut down. Why are bonds down? Because we don't like banks. All right, well, those things are not kind of correlated to gold. Why are bonds up? Because the Fed might ease. Anyway, I see your point. The bond gold relationship is kind of distorted.
Well, because the correlation, if the rally in bonds is recessionary or because of recessionary reasons, then the correlation will be back on. It's like we're in that middle ground where it's actually good. It's like, okay, inflation's coming down. The market is kind of discounting has been discounting a soft landing for a while. And that's why, the dollar going down and the Fed not doing anything is more bullish for the stock market now than gold, even though it is good for gold.
Right.
But it's not really good for gold until you have economic problems and the Fed is forced to actually cut.
And that's everything's like so leading and lagging now. Like you just made the comment that bonds are rallying because of recessionary fears being baked in. That makes sense. And that's kind of what started to happen. And stocks were not strong and bonds were getting strong. And then stocks started rallying. It's like, okay, well, if we're going to have a recession and bonds and stocks are rallying, they're not rallying because of the recession. They're rallying because they think the Fed's going to ease from the recession. And I don't see how they're going to ease. Anyway. What do I know?
Right. Okay. Let's touch on one more thing because I know you got to run. Let's talk about capitulation and forced selling.
Yeah.
Because we have seen some of it in clearly in minors and even junior minors. You get fund redemptions towards the end of the year. Tax loss selling is a big thing in juniors. I mean, we've been dealing with that every year for a decade. A little birdie told me that there was I'm trying to present the information without, so it's valuable to people without blabbing it, so I don't know how to communicate. But I just
Right.
a little birdie told me there was a pretty big fund that I know that owns juniors. They've been having some redemptions. I don't want to give the dollar figure, but I did, tell you. And so there's there, and I mean, it's obvious, you can just look at the market action, sentiment's terrible. This is not like breaking news.
Right. We
per
all
se.
Suspected it. We all
Yes.
suspected it.
But,
It's almost like,
and so I just mentioned this to you, and you having lots of contacts and Europe and Asia, because you're heavy on the futures and the real trading side. That's what I like to say. And so I don't know. I mean, could you share anything?
yeah.
I mean, of what you heard or what you at least told me.
No, well, first of all, you didn't. Let's just to rephrase. Like, you didn't tell me specifics, but when you said it, we both said, this makes sense. This is why miners suck while gold's rallying. Somebody is putting a lid on it. You could probably see it in a chart. There's probably long wicks and things like that. In fact, I looked at a chart, and in the first part of the year, like I was looking at the metal silver. It was like silver juniors I was looking at. Silver rallied and silver juniors rallied, and then in the second part of the year, silver rallied and silver juniors did nothing. I'm like, well, what the heck's that all about? And I was like, okay, maybe it's tax loss selling. But we're all feeling the pain that are long miners, right? So if we're all feeling the pain and you're running a fund and that fund's not making money, then your clients are going to start taking their money back. And so that's what happens. And we think it's like everyone's like us. Everyone's not like us. They put 10% of their money in miners, and they're just like, they don't care. They don't have a loyalty or an understanding of the industry. They just want to make money, so they take their money out. But when you hinted at that with me, and you said it was miners, so I don't really have any mining connections. So what I did was I called a buddy of mine who runs a fund in Asia, and I said, I'm hearing some problems in gold. And he said, I'm hearing nothing like that. This is right. This is like, a week and a half ago, right before CPI. And I go, well, I mean, it's on the mining side, and I don't really know anyone there. Can you check into that? He goes, I don't know anything about mining. And then he goes, oh, wait a minute. There's a conference in Zurich. And some of his buddies were there, partying it up at the trade conference. And so he called his buddies in Zurich, and he said, yeah, there are at least 2 funds that are getting redemptions. And because of the redemptions, they have to sell stocks. Every time the rallies, they're selling it. And so that's keeping a cap on minor rallies. And what he said was more tactical compared to what you said. And it made a lot of sense. And
sorry to interrupt. Well,
No.
because you brought up this point, but I do it because specifically in this the rally we've seen in October, because gold was up nearly $200, that sharp rally. And I mean, GDX and GDXJ, they just did not. I mean, GDX was up, I don't know, 12%, or GDXJ from 31 to 35. So $200 rally in gold, I mean, shot way up, just basically real huge underperformance in GDX and GDXJ. And I'm just, and so I clearly on some of that strength, guys were unloading.
Well, look at your charts. Look at I don't have it in front of me, but so you just you did the October to October comparison. Go back to the last run up gold had, like look at a weekly chart and compare it to the, say, GDXJ. And the GDXJ did okay.
Right. You meant earlier in the year.
Yeah, earlier in the year when gold went up.
Yeah. And by the way, when I look at some of my individual mine, which are in GDXJ, those are not real. They don't really own juniors. They own like mid-tier. The juniors GDXJ owns are like, they're at like the bottom of the food chain in GDXJ. Like those are the real juniors. And those charts are even worse. Like those, I mean, because of course there's been selling in all these names, but my point is in the juniors, their charts have been worse. Like they really did nothing during that
You mean the real juniors, the real juniors.
The real juniors, yeah. The
Yeah.
the $200 rebound in gold. Like they did
Jordan,
not.
that makes complete sense, right? Watch. I'm an arbitrager, right? I'm a value arbitrager, right? And gold rallies, and I go like this. I go, I like this junior. It's a senior junior. It's one of those non-junior juniors.
Right.
I like this.
And Bob
right?
Hoy had Bob Hoy was a great analyst. I'm sorry to go off on a tangent.
No,
he had a great point where he said GDXJ is the senior juniors, basically.
Yeah, right. Senior juniors, right. So they should have like the sophomores and freshmen.
Yeah.
So the GDX juniors, we'll just call it the GDX juniors. I'm an arbitrager, right? Gold's rallying. I go, you know what? I like this GDXJ stock. I'm going to buy it. Or I just buy the GDXJ in general. And the GDXJ, and this is what happens in these irrational liquidations, the GDXJ starts to rally, but it stalls, right? But I'm an arbitrager. I like the company. I'm not going to sell the company that I bought out. I'm going to find a competitor that I think is worth shit because they don't have any proven reserves yet, or they don't have a big float, or they're easy to short, and I'll just go sold. And so it's like I'm buying a Newmont and selling a junior. And so these ridiculous non-hedging hedges going where it's like this, it's like, look, I'm bullish oil. And if it doesn't go up, I'll sell gasoline because they're going into wintertime. People make up these stories. So it's like, I'm buying miners because gold's up. Oh, shit. The miners aren't going up. Well, then I'll just sell every little junior out there because I'm a bully. And that's what ends up happening. These things and that's what happened with the meme stocks. They end up getting blown up in their face. Of course, it hasn't happened in miners yet, but that's exactly what happened. The arbitragers make it even worse than it has to be. That's it.
Right. So concluding with, this forced selling and capitulation, is it over? Are we going to see more of that? Does it end in the fourth quarter at the end of the year, or could we see more of it in January?
Okay. Speaking about the miners specifically, without talking about any miners, I don't know any miners, but understanding how these flows go. So let's look at the mining industry, right? So you have these mining funds out there, right? And at the end of the third quarter, they started getting redemptions. And the boss goes to the trader. He goes, oh man, we're getting redemptions. If we're getting them in the third quarter, we'll probably get more in the fourth quarter. Be careful, right? All right. So they start lightening up their load. They start putting some money in cash. Fourth quarter redemptions come in as you implied, and they're selling every rally. They can't get out fast enough. So those redemptions are done. And you want to say, I want to say, right? Speaking as a gold person, I want to say, okay, the worst is over. It's capitulation. I'm using that word capitulation. It's not necessarily capitulation. And I think that's your point. And the reason it's not necessarily capitulation is because the market is rallying now. The market is strong. All the markets are strong now related to metals because of this buy season, this influx of flows, this fresh reallocation. I think if you want to play the game right now and you're just trading, you're not investing in miners, you want to be long miners and you want to be lightening up your length going into January. Why January? Because January, all that fresh buying is done. And then we see what the mining market is really made of. Meaning, is there going to be more redemptions? Probably not. Probably not for the first quarter. There's going to be new money coming in. But there won't be a lot of new money coming in because generally speaking, when you pull money out, you're not putting money back in. You know what I mean? Like generally speaking, people are pulling the money out for one of three reasons. One, they lost money somewhere else and they're licking their wounds. They have less money to put in. Two, they're pulling money out, as you said, tax loss selling season. They're selling because they have something they're taking profits in and they're offsetting their losses with their profits. Or three, they hate the industry. In two of those three scenarios, no money comes back right away. So if you think miners are undervalued because metal is overvalued, selling metal and buying miners might not work. So The redemptions are done. Where's the fresh money going to come into miners? And I think what we could see is, in technical analysis, you probably call it a rounding bottom. We could have like a rounding bottom. It could chop around sideways for a couple of months. And if gold stabilizes at all-time highs, as you say, breaks above 2,000 by $13, and 2,000 becomes a support level, not a resistance level, then you could see people start to flow back into the miners. That's what I think.
Yeah, because the capital that's out there to actually come in and buy miners, I was going to say David Greenhorn, Einhorn.
Right.
I mean, you probably have some people like him where, they're buying GLD and they're sniffing around, they're accumulating. But with respect to the miners, like, you're not generalist money and all that money, that they're not going to get excited until they see gold at 2,100, a close above 2,100. Then they're going to say, "Oh, look at this break! I got to start buying." Like they're acute. I mean, those guys are not accumulating.
There's a mindset. There's been a mindset in metals forever, and I think and I don't know miners, but there's been a mindset in metals forever, and that mindset still exists, and it's probably bigger in miners. And that mindset is this: oh, gold rally $50, I missed it. They'll pull back. I'll get it later, right? It's always I'll get it later. Now imagine the damage in miners from that. I mean, at least gold is not pulling back like it used to. It takes years to undo that damage. Like gold ride $100, I'll go back to bed. Call me when it drops $75 back. And then it does, and the guy calls you up and says, "Hey, it dropped $75. You want to buy?" He's like, "Nah, it's gold." Right? The mining industry has to be even worse. But what about the takeovers? I mean, was that Hercules? How does that work? Like, why are the other juniors not spiking because of it?
Hercules is a junior, and Barrick Gold is investing a significant amount of money in them. They have a copper porphyry discovery, which looks like it could be really significant. So that, I mean, there are some takeovers, but I think you need a real bull market, and you need a frenzy for there to be lots of takeovers, because think about where the larger miners are. I mean, of course their share prices are stronger than juniors, but
they stink too, right?
Yeah, they stink too. And so how can they justify to their board, like, yeah, we're going to go buy a bunch, we're going to go pick off a couple juniors.
Right.
It's just, you really need a real bull market for there to have more M&A and it become a frenzy. And so I think until that point, you'll just see kind of isolated, takeovers here and there.
That's a solid point, because if you think about it, it's like, why would I buy a junior if my own stock is underperforming? Why don't I wait? Because if they're not buying me, they ain't buying the juniors. Now, there's something I want to add to the whole. It was a copper. It's a copper discovery that made them buy it. Is that what you said?
Yeah, copper porphyry. Yeah, I mean that I'm less keen on those. And this is in I believe it's in Idaho. So which is actually a mining jurisdiction. Like many jurisdictions, there's certain areas that are really good and with it. But
I have something. I guess Barrick they're getting more interested in copper. Okay, that's the phrase. About a year ago, about 7 months ago on Goldfix, I got my hands on a Bank of America report. And the Bank of America report was, I'm sure I sent you a copy of it. The Bank of America report was, the greening of gold. Now, it wasn't cheesy. Bank of America is not cheesy on this stuff. What they realized is they were advising their clients, the big gold miners. They were saying to their clients, gold needs to be green, and to the extent that gold isn't green, it won't be green. However, because of the mining similarities of gold and copper, they started advising their clients to consolidate with copper. So So this is like back then. I still have the post around here somewhere, but the idea was gold miners were losing powerful ESG type investors, responsible investors, because gold wasn't green enough. If they could find copper I think copper and gold exist closely to each other in the ground. I'm not sure that works.
Yes,
right?
yes. Sometimes, yeah, in some
Yeah.
cases.
Right. And I think that's what they were. He's like, let's get some copper. It's even though you and I both know, you're destroying the earth to pull the copper out. It's not like you're not like, you're whatever,
Yeah, let's just make this gigantic hole in the earth somewhere. Yeah.
But when we're done, we can fill it up with the windmill blades that we don't need anymore. That stuff. But or the used batteries from the cars. But the idea was if you want to get to a better copper mines were overvalued relative to gold mines. And so they said, if you buy copper mines, something that fits your profile, you're going to get a boost in your share price. So maybe you're seeing the beginning of that with this Hercules thing. You're going to see like a vertical consolidation with mining. That's interesting.
Yes, and I know you got to run, so let's leave it there.
No, I want to ask you a question.
Oh, all right.
Last time we talked, last time we talked, this is technical stuff, right? Last time we talked, you made something very clear to me. He's like, look at all these wicks above 2,000. It was a monthly and a weekly, right? Look at all these wicks above 2,000. We trade up to 2015. We trade up to 2025. But unless we could substantially close on a decent time period above 2009, that was like the price level you mentioned then. 2,000 isn't a number. That's what you said to me. 2,000 is not a number for this market. It may be a number for people that want to talk about this market, but 2,000 is not a number for this market. We need to settle above it for me to be excited about a potential run for a new high. Is that still the case? Or is the number lower or is it higher? Have you changed in any way?
Yes, on a monthly basis. So you said it, 2009 is the all-time monthly closing high. And,
there you go.
The end of last month, so I think we closed at 1994, and that was actually the third highest monthly close.
It was huge. Yeah, I remember watching that.
Yeah, so but also there's weekly in the 2025 to 2028 range. Oh, and by the way, 2000 is also quarterly resistance. So I get we're in November, but assuming gold can't break through November, December, then we're going to have the yearly, quarterly, and monthly close. So on the yearly, 1900 is actually that's the yearly all-time high. But coming up,
you said 1900.
Yes, 1900 is the yearly all-time high close.
Shut up.
That's the resistance.
Is it really?
Well, let me clarify real quick.
Well, I hope we settle above that.
Yeah, I mean it would appear.
That's amazing.
I guess 1895. That's what it is.
That's amazing.
But so 2000 is essentially monthly and quarterly resistance. So right. That is something to watch at the end of December, and then weekly 2025 to 2028. So those are the levels.
Right. So we hope to attract new money on a monthly close that also is quarterly and yearly close above 2,000. We should definitely attract more money on a monthly close that coincides with a weekly close above 2025. That should be it.
Yes, be it. And so like for example, in December, if we make a weekly close at some point, 2037 or something like that, that probably raises the odds that you would get, the monthly and quarterly breakout.
It also raises the odds that and I'm being facetious here, but it also raises the odds that the bullion banks will make sure it settles under 2,000 for the end of the year. Yeah. You can't settle up there. How dare you? Anyway, thank you for having me on, Jordan. So that's it.
My
so
pleasure.
We're looking at 2009 still on a monthly, and we're looking at 2025 on a weekly.
Yes. And so, how can our listeners subscribe to Gold Fix?
Oh, yeah. I gave you a link before. I'll give it to you again if you need it. For the Daily Gold people and friends of Jordan, it would be 30% off. And it's VBL. It's goldfixsubstack.com. But I'll give you a link for 30% off coupon. You can join for free, and you can get an email or two here and there, or you can sign up with a 30% discount. We'd love to have you.
All right, fantastic. And your Twitter at?
No,
you want to
Twitter,
give that out or no?
I like to keep that separate because of all the crap that I put on there. But it's Soren the K, SORENTHEK, after Soren Kierkegaard. Anyway, Soren the K. But you'll probably see more good music than good gold posts there. But I'm there.
All righty, Vince. Thanks so much for coming on. Always appreciate it. And let's do this again before the end of the year.
Thank you for having me, man. Oh, yeah, we got to do it before the end of the year. You're right.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.